Despite a slight retreat today, the US dollar index remains close to its 4-month highs. Economic data from the US indicates a robust economy with increases in production and in new orders. Today's figures will shed light on the state of the non-manufacturing sector. Federal Reserve officials have also signaled this week that they are not in a rush to cut rates. The market anticipates a reduction of 70 basis points this year, but this forecast could change, especially considering the upcoming US employment data. Let's discuss the most anticipated reports and their potential impact on assets. Welcome to the Fresh Traders Calendar. Traders can expect a relatively stable and uneventful Thursday. Some Asian markets will be closed, and while reports on the US and Canada's trade balances for February might catch some attention, the impact on the market sentiment is expected to be limited, overshadowed by the anticipation of more significant events. Announcements by Fed Reserve speakers could influence the dynamics of some key assets. However, Friday is a guarantee to bring market volatility. The U.S. employment report for April 5 will test investors' confidence in the economy's ability to avoid a recession, even as inflation cools down. Traders will have to assess a pool of data, including the NONFARM payroll report, which, according to economists, may indicate a cooling labor market. Notably, the number of jobs in the non-farm sector in February increased by 275,000, surpassing market expectations, with gains in healthcare, government, and food services. Analysts expect the fresh report to show a slowdown in job growth from February's 275,000 to 200,000. If the data matches market forecasts, it would be the lowest figure since November 2023. Should the actual figures align with the predictions, it would signal that while labor demand remains high, job growth is decelerating, potentially putting pressure on the US dollar. Conversely, if the numbers exceed expectations, the index could receive a bullish boost. To get a comprehensive view of the labor market, it's important to consider other reports as well. A significant indicator to watch is the US unemployment rate. In February, this figure ticked up by 0.2 percentage points to 3.9%, hitting its highest mark since January 2022 and surpassing market forecast of 3.7%. Interestingly, this was the first rise after 3 months of consistent figures. The uptick in US job numbers has boosted the odds of the Federal Reserve cutting interest rates by June. The market is now bracing for fresh data to show the unemployment rate holding steady at 3.9%. Matching expectations would suggest the job market is finding a more balanced state between labor demand and supply, potentially easing wage inflation pressure. If the figures once again exceed predictions, the dollar could face a downward pressure. On the flip side, signs of a cooling job market could lend support to the index. Another crucial indicator of the current state of the labor market will be the data on average hourly earnings. Last month's average hourly pay increased by 0.1%, following a 0.5% rise in January, with wages growing in construction, retail, and professional and business services. Year-over-year wage growth slowed to 4.3% in February. At that time, Federal Reserve policymakers noted that this growth does not align with a 2% inflation target, but is moving in the right direction. The market anticipates fresh data to show an acceleration in monthly wage growth from 0.1% to 0.3%, while the annual figure for March is expected to fall to 4.1%. If the data meets expectations, it could be a bearish signal for the dollar index, whereas an increase in the average wages might lead to higher inflation expectations, income growth, enhanced purchasing power, spending, and subsequently inflation, supporting a more hawkish stance on the economy and the US dollar. The US labor market reports will drive the dynamics for many major currency pairs on a Friday, but the USD-CAD pair may behave differently since the Canadian employment snapshot will be released simultaneously. The Canadian dollar is currently stable and is holding near 4-month low. The Bank of Canada is expected to start cutting rates this year, but likely not immediately, after next week's decision. The Canadian employment report for March could provide insights into the state of the local economy. In February, the Canadian economy added 40,700 jobs, doubling the anticipated growth. However, wage growth slowed for the second consecutive month, and the unemployment rate rose to 5.8%. Chief McClellan stated that this was still insufficient to warrant an early rate hike. Analysts expect Friday's data to show a decrease in new jobs to 25,000 and predict the unemployment rate to rise to 5.9%. If the data aligns with the forecast, the pair's dynamics will likely be minor for the Canadian dollar and more dependent on the US data. However, if the data reflects sharp market changes, the CAD could break free from the dollar's pressure. This has been a brief overview of the key events on the calendar from an InstaForex analyst. Stay tuned for the data released and open successful trades. Wishing everyone profits and see you next time on the channel.